Welcome to the CTP exam prep platform, and my name is Nehemiah Bryant. Today we will cover Chapter 14, Cash Flow Forecasting. We'll go over a general introduction of forecasting. We'll go over the purpose for which and why we do cash forecasting. We'll look at issues and opportunities regarding forecasting. We'll look at the types of forecasts. We'll look at the forecasting process and different forecasting methods, and then try to cover best practices for cash flow forecasting. One of the things as a treasurer that's a key thing we have to do is that we have to estimate the cash position of any organization. Because of that, it's very important to understand what cash you have on hand and what expenditures you'll have to do to make sure that you meet the obligations for the organization. The key thing about this is that it's not always a perfect juggling act or a perfect science. There's a little bit of an art to it, but you have to have a process, a deliberate way of doing things to make sure you can do it consistently and as accurately as possible. A forecast is what it is. It's the best guess you can based upon the assumptions that you have. And the proverbial cat chasing his tail is in vogue here. What you're trying to do is you're trying to get that exact amount the best you can, but what it turns out to be, you're like a cat chasing its tail. Sometimes you always don't get that exact amount. But when you're forecasting, you have to have a methodology by which you develop your assumptions. How have you received cash in over the last 30 days, 60 days, 90 days? What's in your account at the particular moment? What expenditures will you have to pay? What receipts do you have coming in? So a lot of time that's going to vary by day. It's going to vary by time or season that you may be operating in. It could definitely vary by the hour, depending on what's going on at the time. There could be special things that you have to incorporate that maybe weren't incorporated before into your cash forecast. So part of establishing those assumptions is gathering data and understanding the pattern by which money is coming into your organization and that money when it leaves. So when you estimate those future cash inflows and outflows, again, that requires gathering data on how what you spent maybe last year, and then maybe understanding that there were special situations you dealt with the previous year. And then over time, you develop a system by which, okay, during this time, I know I'm going to have to spend on this particular expense, and I get this particular receipt coming in. So estimating those future cash flows really are based on sometimes previous year's information, but what you try to do is you try to gather as much information you can from different parts of the business so that you understand and say, hey, I've got this expenditure coming up. How am I going to execute on that? And then looking at previous things that have helped you in the past understand which expenditures there allows you to develop a prospective budget or pro forma budget and allows you to do those and plan for those particular expenditures. So estimating future cash inflows and outflows are so important. Then you generate that pro forma cash position that give you an estimate of what you're going to have going out, what you're going to have coming in. And this can vary by day, week, and month. Then what you do is you understand then based upon any deficits you're going to have, say for a day, how are you going to cover that? If you have excess cash, and it's going to be more than expenditures, then how do you take that money that's in the account that's going to be excess and how do you maybe invest it in order to earn interest or yield on different investments? So again, it's a balancing act. Then what you've got to do also to incorporate into your cash forecast, you have to estimate what kind of expenses you're going to have from the accounts that you use. That's why we have to look at our earnings credits and understand what earnings credits we need to cover the particular transactions that are going to be happening in our accounts so that then we can get an optimal deposit balance we're going to keep in order to pay for those particular movements in the accounts. So balancing minimum liquidity needs and target balances is going to result in us getting a cash forecast that can meet all those parameters. It seems like a lot, and it is, but as a treasurer, it's very important that you have a succinct process by which you do this, and part of it is going to be based on your cash forecasts. So the purpose of cash flow forecasting, Again, one of the objectives of that is maintaining liquidity. That's one of the major factors of being a good treasurer. You've got to maintain liquidity in your accounts to meet your obligations when due, whether it's investing in different types of securities with excess cash or borrowing from your particular credit facilities. Then you have to maximize your return. So you got a balancing act. You got trade-offs you're always using when you're doing a cash forecast. How do I balance my liquidity needs and have the ability to meet my obligations? But at the same time, how do I then take what I have left and maximize the returns? Some days it's going to be, maybe the focus is going to be make sure you maintain that liquidity. Then some days, based upon seasonality and cyclicality factors, you may have to maximize returns. And then all those things we've been learning about interest rates and the economy and how it affects your overall organization, you really got to be plugged in to make sure you got all the information you need to conduct an accurate forecast. And then how do we then use cash forecasting to control our financing activities? And how do we make sure we meet the objectives of people that need it? Because there could be special projects you got to finance. So how do we then lay aside cash flow to make sure we cover that and then still cover the day-to-day aspects of what has to be done? Then meeting those strategic objectives, really big point here. So maybe your cash forecast, when a strategic objective kicks off, how then do you incorporate all the fundraising and things that you're doing as a treasurer to make sure those objectives are taken care of while at the same time maximizing returns, while at the same time balancing liquidity? A lot of things you have to consider. Then making sure you're budgeting your capital. You know, one of the things you want to do in a cash forecast, you want to be anticipating the future so that you can lay the groundwork for planning that takes to when that event does occur at the time it's supposed to occur, you're already prepared. You're more proactive versus being reactive. Then obviously, one of the key aspects of the treasury is managing overall total costs. You want to manage not only the cash flow you have, you want to maximize returns, but you also want to be able to manage your costs and manage your borrowing costs by not having to borrow from your lines all the time. So that's a balancing act. To be optimal in that sense, you have to make sure you understand the data that's coming in and what it's telling you. Managing that currency exposure, because if you're a big company that has international operations all around the world, you're dealing in different currencies, you got to be aware of when you've got shortages in currency and making decisions on how am I going to pay the bills in that subsidiary. Or am I going to borrow and have to translate that currency maybe that's dealing with the parent office, that's in the parent office, and dealing with that subsidiary? Or can I move money around based upon in my accounts to support that subsidiary and maybe doing an intercompany loan? You have to also be aware of the tax implications of that strategy and also maybe the laws that are germane to that country. So managing currency exposure is a big thing. And then last but certainly not least, meeting your compliance requirements. That's the baseline. You've got to make sure you operate within a prudent, ethical manner and also in compliance with different laws and rules and regulations in the countries you deal with. Big task to cash forecasting, but we think we have a solution to help you, show you how to do it and do it consistently more effectively. There's issues and opportunities in forecasting. One of the things is keeping a forecast where it's not overly complicated. It's relatively simple. So you got to develop yourself a process that you feel comfortable with. Can't be just willy-nilly, obviously, but it has to be one where you can operate and do it consistently, following step-by-steps, and something you can train your associates to do if you supervise those, or something you can do if you're doing it to make sure you're consistent. And you know, the thing about what you have to do with a forecast, and the big thing what a lot of people don't do, it's not just estimating a number. You've got to take the information that you had for that forecast and look at it and see how close you were to the actual situation that happened. So if you forecasted $750,000, if you were off by $500,000, I think you need to look at your methodology by which or how you're conducting your forecast. But if you were close and say, for instance, you came in at 751 or 752, then you can be pretty confident that your forecasting model works to advantage where you're as accurate as possible. Again, the proverbial cat chasing the tail, you may not be able to get exactly right, but if you come within a range that you're comfortable with, then that model you use can be simple and reasonable, simple enough for you to use more consistently. It takes a lot of collaboration and communication. Again, we talked about Treasury being part of that instance where you're plugged into many different areas of the organization. And in order to do a cash forecast, it is very important that you gather data from those organizations, and those organizations are willfully and able to give you the data you need so you know what your expenditures are, what your receipts are, what you have coming in, what you have going out, so that you can make sure that your cash forecast is as accurate as possible. What you want to do is avoid duplication of time and effort. You want to be able to have a forecast that you can have confidence in and succinct enough to conduct your day-to-day operations. And then what you want to do, you want to, again, like I said before, look at your variances. It's very important to forecast that you try to hit your variances as close as you can as possible. What you try to do is you try to look at your actual, and then making sure that what you forecasted was as close to the actual as possible. If you have a far off, then you need to look at your model and see, am I model really incorporating all the information that I can get in order to forecast more accurately, or am I being a little bit too aggressive and trying to get it exactly right when I need a range? So again, making sure that you incorporate that variation to help your forecast get better and better next time. You're always trying to get to that nirvana of getting the exact forecast. Even weather forecasters, with so many models they have and so much data they take in, sometimes weather forecasters are rarely right spot on with the temperature, let alone predicting where a storm would hit or where rain would go. And that's kind of the same thing when you're talking about a treasury forecast. You try to get in the range where you get as close as possible, again, to keep it very practical and usable. So what type of forecast do you usually have in a treasury shop, and how are they used? Well, you can have short-term forecasts, long-term, and medium-term. In a short-term forecast, that's typically looking at something from a daily, weekly, monthly basis, and maybe even quarterly. Again, what you're trying to do here is predict your cash receipts and disbursements and possible resulting balances that could be had based upon those receipts and disbursements. Then from a medium point of view, you can look at things from a 3 to 12 month time horizon. And then you're trying to project monthly and quarterly cash flows, inflows from sales and outflows from expenses. Then you have those long-term projections, anything beyond 1 year. And you're trying to look at long-term sales and in strategic planning to try to figure out, hey, what could be our cash position this time? Will we have to go get other facilities and make sure they're in place if we're going to have repeated shortfalls? So all these forecasts are very essential, not only in the short term, making sure day-to-day operations are taken care of, but there has to be some planning time horizons. And I can tell you from experience, a lot of times you got to be plugged into the manufacturing part, the logistics piece. You got to be plugged into what's going on with a certain project that the board of directors and senior management may have on the horizon. Maybe mergers and acquisitions that could be going on. All those things have to be taken into account because a forecast is ever evolving and it's dynamic. So you have to, sometimes change it and tweak it as you go, but it's never really ever locked in. So, you go with your forecast, what you have. If it's right, then good. If it's not so accurate, then you always go back to the drawing board and make it better. And so here's a discussion question kind of going over what we currently discuss about forecasts. Basically, the question says, identify the following forecast horizons. And the answers are to the left, but I want to go over those so you have a perspective of what we've been talking about over the last few minutes. So in number 1, when it talks about establishing and managing target balances for bank compensation, that's typically considered a short-term forecast because those are target balances that you're going to use to maybe operate payroll or pay particular people. And since people are not going to wait 90 days to get paid, that's something that you're going to have to make sure that you account for in your account on a daily, weekly basis. So that's typically considered a short-term forecast. On the number 2, it talks about using a forecast to determine a company's need for short-term credit and availability of funds for short-term investing. That's considered a medium-term forecast. And the reason being for that, you're meeting your daily requirements, but what about availability of funds maybe in the next 3 months or so? Looking at your credit lines, looking at availability, looking at possible investing opportunities because maybe you're planning to have excess cash in a few months' time. So medium-term forecasts kind of are short-term, but there's still long enough time horizon where you can have some planning horizon. And when it talks about number 3, used as a benchmark to compare actual to projected cash flows on a cash budget, well, that's medium term. And a lot of times you want to have a benchmark. You got to have something to measure how accurate you are in your cash flows. That's the reason you do a projection and a budget through this forecast. So you got to be able to compare your actual to what you projected in your forecast so that, again, you're trying to make your forecast continually accurate as possible. So that's considered a medium-term forecast. And then on the 4th statement down there, it talks about used by financial institutions and rating agencies for credit analysis. That is long-term, because many times, how are you going to establish trends and looking at things from a credit standpoint, since a lot of credit facilities can be not only short-term but longer-term instruments. These are considered more long-term forecasts. So the next discussion question we have is, we ask this question: which is the step at arriving at the closing cash position? So the answer here is C, deducting projected disbursement totals. And one of the things we talked about on a short-term forecast was making sure you understand what receipts you have coming in and what disbursements. So in order to make sure you understand your closing cash position, so after all of that is done at the end of the day, what's going to be your estimated closing cash position so I can plan the next day, you've got to understand the amount of projected disbursements that you have going out. So what do we want to talk about here? We want to talk about what we call degrees of certainty, or information that we know now so we can conduct a forecast. So one of the things when you talk about degrees of certainty, you want to, at the best of your ability, understand what is definite. What do we actually know regarding our forecast? And a lot of that has to do with knowing things in advance. So if we know that a project is coming down the pike where we know we're going to need those projections in order to make our forecast more accurate, we need to know that in advance, not last minute, not yesterday, or not ASAP. We need to know that more in advance. We need to know possible interest that's going to be paid, principal repayments, dividends, royalties. We have to know that information because all of that is going to feed into our forecast. Those are disbursements, so we have to know those things in order to get a good disbursements model and forecast. Then some aspects we may not totally know, but they can be predictable based upon previous information. These type of things are a predictable degree of certainty regarding, different levels and patterns. What have you seen over the last 7 days? What have you seen over the last 3 months? What have you seen over the past year? So, and those things have to be pretty consistent. There can't be a lot of volatility where the amounts were out of a certain range. So being able to be predictive and have reasonable accuracy allows you then to predict what could happen if, given all things remaining constant, those particular aspects that influence those past amounts, if they remain constant, then you can predict with some sort of certainty maybe future actions. And then there's those with less predictable, those that are difficult to forecast. We don't know what interest rates are going to do. We don't know how the economy is going to project. We can run models, we can run scenarios, we can try to extrapolate what we think, but at the end of the day, some of that is less predictable, so it's difficult to forecast. So you try to do your best judgment, but it could be wide ranges where things could fall out of the range that we're comfortable with, but we have to consider that anyway. So a lot of times you have to get experts, people that have been around a while and that have seen how different changes in the economy has affected different operations. So you involve people that experience that could give you perspective on what they've seen happen so you can make your forecast a bit more accurate. And then you can look also and do research. How have other companies done with certain types of product sales? You can look at how an unexpected repair, since you may know something is going on in a specific area, there could be a failure. How do you project how that failure will impact them? Different types of costs all over the organization. So this is not for the faint of heart. It's something that you do to the best of your ability for what you know, but there's definitely degrees of certainty that can impact the numbers that you come up with in your forecast. And here's another discussion question when it talks about different validations. And we didn't go over this, but I will go over this right now. And it talks about which validation method tests a forecast using data that was not used to develop it. So you've got data necessarily that wasn't in your data set that allow you to do the forecast, but it can allow you to give you more information to help you regroup and make your forecast a bit better and a bit more accurate than it could have been. So it says, which validation method tests a forecast using data that was not used to develop it, i.e. using 30 months of data for the forecast and the last 6 months of a 3-year period to test? And the answer is B, an out-of-sample validation. So like I said, sometimes all the data may not be available. And so you have to be flexible in your forecast to be able to bring in more data as you get it. And it could be ongoing. And I know that can be frustrating because you may have already done your model and you have your forecast set in stone, but then new data might come in that you may have to revamp the assumptions you made in your model. So it's very important to be flexible, and in an out-of-sample validation, that may be something you need to consider because of a scenario variable that you developed. So now we've talked about kind of generally how forecasts work. We've talked about how forecasts can help you plan your disbursement and receipt operations, how it can help you project your cash flow needs in a general sense. Now in this section, we're going to talk about different methods that treasurers use in a general sense that help them create their cash flow forecast. This may or may not be pertinent to you, but I think it's very important to expose you to many different aspects of forecasts depending on the situation that you may be in. So the first one we're going to talk about is an accounts receivable balance pattern distribution forecast. So basically what you want to do here is make sure you look at your accounts receivables. So you may have made a sale. You may have made a sale, say on June 1st. And there's going to be certain times that total sale is going to be consummated. So you may have had payment terms, say for 30 days or however long you've negotiated with the client for this sale. So, and then you may have negotiated with different sales patterns and payment terms with different types of clients. So everybody's not going to have always the same payment terms, and everybody's not going to have the same terms negotiated. So what you want to do is look at accounts receivable in general to discern, okay, after I make the sale, how much money can I expect from the number of sales that I have outstanding to how much I expect the first week? How many can I expect in the second week, third week? And then pretty much understand when will the total sale consummate? When will the sale finally execute fully and I receive all of the sales that I'm due? So you want to do things such as a simple average and actually use an estimating tool called regression analysis to kind of predict when you will receive sales. And then there's called what we call a receipts and disbursements forecast. Basically want to see things like looking at a schedule that you may have. So again, you may look at your sales and then try to estimate based upon when those sales consummate when you will receive receipts at different points in time. Same thing with disbursements. You want to be able to estimate when will you disperse items and then how much cash you will have going out of the organization. And then you want to have a completed forecast where you look at both receipts and disbursements. Then you have what's called pro forma statements. Pro forma is a Latin term for matter of form. So that means all you're doing there, you're trying to estimate future cash flows and receipts based upon how the financial statements will look at a point in time. We've talked about cash flow statements and how they help you estimate things when you're looking at different financial statements, maybe 2 years or so. So after you look at those, you can then use those pro forma cash flow statements to see, hey, how much cash will I have and what activities are going to influence my cash flows based upon the financial statements. And then we can even get a bit more sophisticated and look at statistical forecasts, where we look at things such as a term called alpha, where it looks at patterns within a distribution set where you have a constant that will be applied to data no matter what the data does, so that you can be more accurate and succinct in getting the estimated forecast as close to the actual as possible. So let's look at the AR balance pattern here. So here we have a situation where you gather data and looking at your sales. So here, the data is seeing when a sale is made, how long does it take to recoup the total amount of monies from that sale? So when a sale is made, typically with the data that's gathered in this situation, sales usually in the first few days, only 5% will be collected in that month. In the second month or month one, then looks like about 40% of those sales are collected. In months 2, 3, and 4 subsequently, there's 35% to be collected, 15 and 5. This is very important data to see in general because you got a lot of sales going on. Like I say, you could have sales and you could have different payment patterns or different contracts that were negotiated. But in general, you want to see, sales in the aggregate sense and basically be able to narrow down, okay, how much is it I should expect? And again, this is a forecast, not as an exact amount, but how much should I expect to get based upon the patterns that I've seen? And again, to make a forecast accurate, you've got to continually gather more data to make sure these patterns hold for a certain period of time. So let's look at this from a standpoint trying to use this model to estimate our sales receipts for the month of May. So in this example here, we know that it takes about 5 months to consummate a sale. So we have to go back to sales patterns within January all the way to May. And here we know that January sales, we're still receiving January sales as far as the forecast, receiving forecast amounts from February all the way to May. So we apply that model we developed and say, okay, here it is in January, we're going to receive 5%. In February, we're going to receive 15%. In March, we're going to see 35%. In April, we receive 40%. And then in May, we receive 5%. We basically take the model and the amount percent collected per month, and we apply that same model to make sure that it will be applicable to trying to estimate sales based upon our recorded sales that we have. So here in the month of May, after the math is done there, as you can see, we take the percentages and times them by the amount of forecasted sales. So in January, we had 350,000. So we apply that 5% times that, and we get an amount we should receive from January sales in May, and so on and so forth. So then we look at the estimated collections forecast in May, and so we've taken that data and made a forecast in May based on the amount of sales we have. And then you can use this subsequently for other months that you have maybe forecasted by moving those percentages down as sales are made. So very good tool that you can use. And again, it's a forecast, but then it allows you, again, that data so you can begin a planning horizon to make sure you got cash available to support those sales. So that we looked at the AR pattern distribution method. Now we're going to use forecasting using business days when we can expect dollars to clear. So in this situation, the company has used regression analysis and found the proportion of dollars clearing depends on the number of days since the distribution. So here, some data has been gathered where you look at the days since the distribution. So you have 5 days. So basically what they're saying is from the time a check is written or time an ACH is done or whatever payment method is done, typically it takes an average of 5 days for the total amount of dollars to clear. And so what they've broken it down here by particular days. On day 1 is 13%, all the way to day 5, which is 8%. And the total percent adds up to 100%. So it gives you the amount of days. So pretty much the most days you're going to get a lot of your money back after the transaction is done is day 2 and day 3. Other days still matter, but pretty much day 2 and day 3 are those amounts. So then you apply a situation where you had, in this case, $100,000 in checks was distributed out. So you're trying to estimate when would that $100 totally clear from May 1st. So it looks like it takes a week, so it's 5 business days, but it takes a week out because there's a weekend factored in. So they apply that percentage based upon when the checks would clear during the week. So they've then done a forecast of out of that $100 that was dispersed, how much would come out on Thursday, how much would come out on Friday, all the way to Wednesday. So it was a good planning tool, again, to see how much disbursements you would have. So we looked at, first of all, how from the sales, how much sales we figure receipt and then cash flow that we could have available. Here we're looking at how much disbursements you could have in order to make sure you understand what cash needs that you may have for each day and all the way to that week. So then here you've got a receipts and disbursements forecast. So what we're trying to do is, in general, kind of look at this as a medium-term forecast to see, okay, given the patterns of how we do receipts and the patterns of data, how we do disbursements, now combining these, how does it tell us for what type of facilities we're going to have to draw from in order to get our target balances the way they need to be? So as you can see here, they're looking at the cash receipts, what you've got coming in. They've estimated them for the past 3 weeks. You look at the cash disbursements, and again, these are estimates, what estimate cash disbursements you're going to have. Then it shows the amount of net cash flow. As you can see, in week 1, there's a positive cash flow. So when you have positive cash flows, you might want to look at short-term investments that can help you earn some money in the interim while you have this surplus. But in weeks 2 and 3, you notice you have deficits where you're going to have to find money or maybe move money around or even possibly have to borrow money in order to make sure that you can meet your needs. So then it gives you an estimated cash balance, and then it shows you the beginning and then the end of balance after week 1. And then it gives you even the target balance that you're going to need in your accounts to pay those earnings credits for the transactions that you have. So then here in week 1, you can see you have investable funds, where in week 2 and week 3, you got deficits. That's a good planning horizon, because now you can check, okay, do we have facilities? Or if I know this subsidiary's got excess cash over here, can I really move that excess cash maybe into a master account or maybe a concentrated account to make sure I have enough here to have available? So again, it allows you a horizon to kind of see, okay, here's triggers here, here's triggers there. I've got a surplus here. I've got disbursements here. And again, allows you a planning horizon as a treasurer, not to react to everything, but to try to be as proactive as possible to meet your corporate needs. So here's a disbursement question here when we talk about complete the percentage of sales pro forma statement forecasting steps. And I know this is very difficult because for some of you this may be new, but again here we want to understand the answers here. So again, it's trying to get you to understand the process using a pro forma statement. And we haven't gone over pro forma statements, but we will here shortly. So here the answer is A. So here when it talks about what you need to do in a pro forma or matter of form statement that you're projecting disbursements and cash flow in the future. So here you want to look at, in A, the income statement and balance sheet, and then you want to look at the cash balances, because you're trying to estimate what are going to be your cash needs in the future. So here is what we're going to talk about with a pro forma. So what we've got here is an actual income statement that was done, say, the previous year. And then here's an actual balance sheet that was done. And it shows you the current financial position of the firm as of December 31st, 2016. And these particular amounts, as you can see, with sales and with cost of goods sold, there's percentages listed there. Based on the patterns we've seen, cost of goods sold in this case is 75% of sales, and then selling administrative expenses are 10% of sales. So that allows you then to estimate what possible other amounts will go into the actual income statement, and then it shows you what your net income, which has resulted. So those percentages give you a guide then to see what could be the amounts that are projected in the future. And then you have your actual cash balance or your balance sheet. Notice you have percentages there that show the amount of cost based upon the amount of debt is informed for notes and bonds. And then you have the cash position there that shows 100 in your cash balance. So in the pro forma, what you try to do is you try to take those percentages and estimate how they influence future operations. So we take those amounts and we estimate it. Here, in this particular pro forma, we had a 10% increase in sales. And then subsequently, based on percentage, we had a total increase in, or estimated increase in cost of goods sold and selling admin expenses. So it resulted in more retained earnings. But then when you look at the other accounts, the increasing debt, increasing payables it took to support the sales, we actually, in the pro forma balance sheet on the bottom, have a lower amount of cash from the operations that we've done. So here, sometimes when you take into account many different variables that ultimately affect the firm and the cash flow in the firm, sometimes, again, this allows you to see from a sensitivity scenario perspective, if we do this, what could possibly happen? So this is a very good forecasting tool to plan future operations and allow you to see, okay, do we need to change our strategy a bit? Do we need to change sources of money where we get them from? Do we need to lower interest? All those things can be incorporated by doing a simple pro forma extrapolation of what has happened in the past and what you can estimate in the future. And in this discussion question here, we're going to skip this because it's hard to see, but it basically what it did, we took those statements from the last slide, and then what we did was we did an estimated cash flow statement. So here, what you're seeing here is you're seeing the changes that happened. So we started out with $100. So then we saw the particular changes from the income statement. We had more cash flow from net income, but we also had other changes from the operating accounts on the balance sheet. We had more accounts receivable that needed to support the increased sales. We had more inventory that took to do the more increased sales. And we actually extended our payables a bit that generated some cash flow. And so that gave us some good cash flow from operations. But look what we had to do. We had to borrow more money to support financing activities because we paid off debt and we paid dividends. We also had to buy other fixed assets to support those sales. So you have to look at the assets it's going to take to support those sales. And then in your pro forma balance sheet income statement, you can extrapolate that into a cash flow statement, pro forma, and see will you have more cash or not. In this case, we have less cash, but if it's accomplishing the objective, cash did not go down that much. So it may be something in this particular scenario the business would do. And it gives them estimates that give them the data to back up their actions. Here we're talking about what we call statistical forecasts. So here you're using some higher level statistics based on we're trying to extrapolate the data from the past and really do a better job in giving us more of an exact amount of what we think is going to happen in the future. So we try to look at data more objectively, not based on opinion, but more objectively. So you got things that you can use to use statistical forecasts to help you create better forecasts. One is a time series forecast where you look at repetitive patterns of historical data to predict future values. And we use those through different tools such as a simple moving average and an exponential smoothing. And we'll go through these in just a minute. And then we can look at also trends. So as over time, when you start seeing trends, either something going up consistently or going down consistently, that can give you an extrapolation of what you think is going to happen. We can look at seasonal patterns because in some businesses get their cash flows more in a few months than they do in the whole entire year. There's those few months where they get the majority of their cash flows that occur within a year. Then there could be cyclical patterns. Like I said before, when you talk about economics, different businesses may react to different cyclical patterns in the economy, such as education. When the economy is booming, education typically goes down. But when the economy is not booming, people go back to school, and education is then booming. So it's kind of counter-cyclical to the economy. So you have to factor that into your projected forecast. Then there are random movements. How do those random movements, Derek, how can they affect our forecast? So what you try to do with these statistical forecasts is incorporate all that data to make as much of an accurate forecast as possible. And here with correlation, you want to look at different variables, especially 2 or more different variables, to see how one variable affects the other. In this case, maybe sales and cash flows. So here's an example of a simple moving average forecast. Here you've gathered about 6 days worth of data, and then you start your moving forecast. It's basically a simple average. So in this forecast, you're trying to average here the average forecast for day 7. So says it takes about 5 days of sales to create this particular forecasting model. So here they take days 2 through day 6, and they basically do the net cash flow. And what they try to do is then estimate what the next cash flow in day 7 will be. So they took the actual cash flows that happened on day 2 and day 6 and divided them by 5 days, what we call a simple mean or simple average. So it came up with an average for day 7 of $761,200. Notice the wide variation between the net cash flow, what actually happened in day 7, versus the 5-period moving average of $761,200. Here you can see there's a wide variance because for some reason, maybe there was a variable that wasn't taken into account, i.e. a special situation. So sometimes the moving average can be somewhat accurate, but in other times, if it doesn't take into factors, a simple moving average can be very inaccurate. So maybe you need something here that kind of takes special considerations of hidden patterns in data that might not be self-evident during a simple moving forecast. And for this case, you might want to try what we call an exponential smoothing forecast, where you're looking at data and you're applying different variables to take account reconciling the actual to the projected. Here in this case, we have the same one that we did the simple moving average for. You have the 812,000 all the way to day 6 to the 748. So here you're estimating, day 7, but then now what you're trying to do is put a coefficient there to help you get more accurate and closer. So you can see here, we estimated in the previous 4 moving average forecast, we estimated 761,000 and some odd dollars. In this case, with the exponential smoothing, we got an amount that, even though while not as accurate or close to what was still the net cash flow, it gave us an amount that was larger because what happened was it gave us an amount that considered a correcting factor or variable we didn't necessarily see. So we have this coefficient called alpha. And what alpha tries to do is try to help you reconcile what was estimated to what actually happened. So here we have an exponential smoothing forecast for day 7. So we put this coefficient to actually what was the net actual cash flow. And then we take into account the current period forecast and we put the 1 minus alpha to that. So as you can see here, this is the way we reconcile using the exponential smoothing. You got a bigger amount, and compared to the last slide here, you can see where we got 761,200. Here we've got the 773,100. So this factor that we put in helped us reconcile the actual situation happened to the projected by giving some weight to the actual amount, but still giving credence to the particular forecast. And as you see with the exponential forecast, you go on further, you get more accurate as things change. It incorporates more the actual with the projected. And then we have other types of tools we can use called regression analysis. And basically here we're looking at 2 variables. We're looking at what we call the independent variable, or what's on what we call the x-axis in the independent variable, here being sales. And so we're trying to forecast net cash flow, since we get cash flow ultimately from our sales and then we have to subtract expenses of what that estimated could be. So it's got a set of data there. And again, there's variables of that data. The biggest thing with regression forecast is you have to make sure that those particular variables within that specific area or data remain constant. If there's changes, you really need to incorporate and do a new regression forecast based upon new data that you have. But as long as it stays within that range, you're fine as a predictive model. So here they're basically using the old equation y equals mx plus b, rise over run. And so it's interpolating the y, the intercept, based upon the data where it crosses the y-axis. And then it's taking the slope that's formed from the data and basically estimating sales. And that data is kind of a multiplicative concept, basically showing for every dollars of sales, how much net cash flow is generated. So in that slope, basically it's saying for every dollar in sales, approximately 16.98 cents is then generated of cash flow from each dollar of sales. So here you basically interpolate the numbers, wherever it falls. And typically this is a program that's done in a statistical package, maybe in Excel or some other statistical package you may have. So the cash flow here is the y-intercept, which is minus 86,057. Which is basically saying at 0 sales, you're going to burn through a lot of cash. In fact, you're going to burn through 86,000 of it. But if you have sales, and here they're projecting 6 million in sales, estimated when you take that amount from 0 sales and then you estimate the amount of possible cash flow based upon this level of sales, you can have net cash flow that's in the positive of $932,743. Again, this is a model. It's not saying it's exact. You still want to compare the actual to the projected, but if this was pretty close, then your model has some validity in that it can be a model that's relied upon to project your cash flows. In this discussion question, we discuss the items below are listed some of the best practices. So again, we want to talk about having a consistent process. So understanding best practices in cash flow forecasting can help us develop that consistent model in order that it can be reliable and consistent, something we can use in our day-to-day, week-to-week, month-to-month, and even medium and long-term forecasting models. So here, one of the things it's saying here is a best practice: make sure you have appropriate detail. If you're doing daily, then the data needs to match a daily type model. If you're projecting more medium or longer term, the data needs to reflect those type of models. So appropriate detail based upon the forecasting model. And here we're talking about the appropriate platform, or the appropriate, is it correct based upon the situation that you're using? Invest in the appropriate amount of resources. Again, time, energy, money, whatever resource is going to require for you to make sure the forecast is as accurate as possible. You validate the forecast, which means that you don't put something out there that you're going to be immediately used. You test its validity to make sure that it functions the way it's supposed to. Then you cooperate and communicate, which means that you gather data from your various sources, making sure that data is validated. And then you ensure that the forecast is usable. So these are things that you should be practicing your forecast. Now let's determine on the other side, which is another aspect of these best practices. And the answer is D, disclose your assumptions. The first step we learned when we started this chapter was make sure you establish your assumptions. So you need to make sure when you're disclosing your assumptions that those assumptions can be poked at. They can be challenged, because if the assumption is not correct, garbage in, garbage out, your forecast is not going to be correct. So disclosing those assumptions are very important, because they can be challenged to make sure they are valid, they do hold for the situation. This concludes Chapter 14, Cash Flow Forecasting. We've learned what the purpose of cash flow forecasting makes you as a treasurer to be able to have reliable means of planning your operation to make sure you have adequate liquidity, you have be able to provide the cash resources needed by the organization, and possibly invest idle cash where needed. We've looked at issues and opportunities in forecasts. We've talked about the cat chasing its tail. Forecast is never going to be totally accurate. It's going to be something that you're always going to be dynamic. It's always going to be evolving. It's always going to be something you can do to make it more accurate. We've gone over the different types of forecasts when we're looking at AR, different disbursements, estimating sales and cash flow. We looked at what we call short-term forecasts. We looked at medium range forecasts, and we looked at long-term forecasts. All those different types of forecasts help us as treasury professionals plan our overall day-to-day, week-to-week, month-to-month, year-to-year operations. We looked at different forecasting processes, such as simple moving average, such as exponential smoothing, such as regression analysis, such as pro forma forecasting. All those particular forecasting models are allowing us to take hold and be more proactive and be able to be decisive in our decision making. And then we looked at best practices, when they would be particularly used in particular situations. That concludes Chapter 14, Cash Flow Forecasting.